Welcome to the Aviation Insurance Podcast, the podcast that helps aircraft owners and aviation businesses learn and understand the complex world of aviation insurance and risk management. From the basic principles of aviation insurance to risk management techniques and updates on the aviation insurance market, the Aviation Insurance Podcast is your guide to traverse the world of aviation insurance. Now, here's your host, Tim Bonnell.
Well, welcome back to the Aviation Insurance Podcast. And if you're in the aviation business, you own an aircraft, you've undoubtedly been asked to sign some form of an agreement and asked to provide a certificate of insurance. And so today I wanted to talk just a little bit at a high level on what a certificate of insurance is, what it does, and what it doesn't do. Again, this can get into a lot of legal issues, so this is a high-level discussion only, and any legal issues or implications should obviously be talked to with your attorney and your aviation insurance broker and your risk management and legal team. So, a certificate of insurance is a document that evidences insurance coverage from one party to the party requesting the certificate. The requesting party is typically referred to as the certificate holder, okay? And we're asked to provide certificates of insurance for a lot of reasons, right? So someone buys an aircraft and has a bank. Their lender has certain requirements, and they want a certificate of insurance to demonstrate those requirements. Many airports, fixed base operators will have hangaring or service agreements that they'll ask for their customers to sign. There's lease agreements, maintenance agreements, all kinds of vendor agreements where certain insurance coverages are requested and the coverage and evidence is requested to be afforded. So what does a certificate of insurance do? It demonstrates the policy is in place to address the certificate holder's insurance concerns or requirements. This includes the named insured information and address, the insurance company's name, the policy number, the policy effective dates, as well as the key coverages, limits of liability, insured values of the policy. So it evidences those things. It evidences the status of any additional status is afforded to the certificate holder. So let me explain that a little bit better. So there's 4 common statuses, and there's others, but these are 4 commonly requested statuses from the certificate holder that the insurance companies will provide. And they each have a lot of other issues we can go to at a different date, but one of them is an additional insured. That's pretty regular. According to IRMI, the Insurance Risk and Management Institute, an additional insured is a person or organization not automatically included as an insured under an insured insurance policy, who is included or added as an insured under the policy at the request of the named insured. All right, so this typically applies to as the respects of their interest, typically, as respects to liability or third-party concerns. So additional insured extends some third-party coverage. What it doesn't do, it doesn't increase the coverage. It doesn't increase the limit. It just shares the limit by adding the additional insured to the policy and actually dilutes the limit because everyone's sharing the same limit of liability. But it is frequently requested and required. So additional insured. Another one that's requested sometimes, a waiver of subrogation. According to IRMI, again, a waiver of subrogation is an acknowledgement by an insured that it has no right to subrogate against a liable third party after it has paid a loss on behalf of its insured. So somebody causes a loss, an FBO or MRO damages an aircraft, and they had asked for a waiver of subrogation so the insurance company wouldn't come after them for the cost if the insurance company had paid the loss to their insured first. So again, there's a lot of information we can go to on a waiver of subrogation, but that's what it is in quick terms, and that's typically requested. There are a couple other things we typically see, especially as it applies to a bank, so a lender or a lessor, a loss payee provision. So the loss payee is the person or entity that is entitled to all or part of the insurance proceed in connection with a covered party in which it has an interest. So basically, their name goes on the claims check if there's a claim. So the lessor certainly, and someone with a note where the aircraft is part of that security, they're going to want to be a loss payee on the policy, and that's what that provides them. Their name goes on the check is how I like to put it in simple terms. And then the bank or a lessor may ask for a breach of warranty. In simple terms, again, according to IRMI, a breach of warranty often abbreviated as BOW. The clause refers to a lien holder or bank's or lessor's interest endorsement that causes the policy to continue to protect the financial interest of a lien holder or lessor, even when the insured breaches a condition of their policy, thereby avoiding coverage. So if the insured does something that voids coverage, this is one mechanism where the lien holder or lessor's interest, so not the full policy amount, but their particular interest in the asset is protected by this endorsement. Again, there's conditions on this. They have to go through a number of steps. There's other issues that apply to. But those are 4 regular issues. You'll see the statuses afforded to the certificate holders you'll commonly see on a certificate of insurance. So it evidences coverage, the policy information, the insured information, some of the coverage information. It evidences some of those that status information for the certificate holder. But here's what a certificate of insurance doesn't do. So number one, it doesn't change the terms and conditions of the policy. Any changes to the terms and conditions of the policy, any additional insureds need to be approved by the insurance company. Those changes need to be endorsed to the policy. It will actually endorse or provide an endorsement to the policy to evidence those coverages, and then the certificate of insurance will be issued to evidence that coverage. So the certificate of insurance does not amend any coverage, limits, or values. They have to be approved by the insurance company and an endorsement issued. That is huge. Okay. That's why a lot of times people want to see an endorsement that makes a change in addition to a certificate of insurance. Number two, a lot of times you'll see the language that the certificate holder and basically in the contract, they will ask that you will be indemnify them to make them whole in the event your negligence leads to a loss for them. Now, an indemnification, that's a whole nother issue, but indemnification means to restore them to whole, like take care of all their costs and expenses related to that claim. Well, indemnification usually doesn't have an end date, and it usually doesn't have a total cap amount. And so a lot of times, if your insurance carrier agrees to the agreement, they approve the agreement, and contractual liability is something on the policy, they're only agreeing to cover that indemnification up to the terms and conditions of the policy. They're not changing the terms and conditions of the policy at all. So if your indemnification requirements went beyond the scope of the policy in terms of the limits provided or the dates coverage is provided, there can be an issue. So just keep that in mind. A certificate of insurance can evidence there's coverages, and the insurance company can approve the agreement, but the indemnity ends where the insurance policy terms and conditions end. All right. The third thing an insurance certificate of insurance does not do is it does not evidence all terms and conditions of the policy. It doesn't outlay all coverages typically. It doesn't include all the sections. It doesn't include all the conditions and exclusions or endorsements. So it is just evidencing certain key coverages that are afforded under the policy, not all the exclusions, not all the definitions, and so on and so forth. So it does not replace the policy. So all that in mind, there are a number of common issues that we find due to certificates of insurance, or that come up with certificates of insurance. Number one, the actual policy changes weren't made or approved on the policy. They were just put on a certificate of insurance. Now, this is a bigger deal when it's the agent or broker issuing the certificate of insurance. I personally prefer, in most cases, when possible, to have the insurance company issue the certificate of insurance. This is for a number of reasons. I won't get into all of them today, but you want to verify that the changes were actually made on the policy. When you're dealing with quota share policies where there's more than one insurance company providing the coverage, or certain types of policies, the agent broker does have to issue the certificates either way. So it's important that the changes are actually made on the policy, not just issued on a certificate of insurance. Otherwise, they're not effective. The change has to be approved by the insurance company. Another thing is when someone gets a certificate of insurance and an underwriter even approves the contract, liability assumed under a contract is excluded from the policy unless it meets the definition of an insurance contract, or contractual liability is a coverage that's endorsed to the policy and that contract has been approved per the terms and conditions of the policy. So it's always a best practice that when someone's requesting a certificate of insurance, it's as a result of an agreement to send that agreement for approval to the insurance agreement, to the insurance company in advance. A lot of times they'll give you a period of time to report them. Maybe it's 30 days, depends on the policy. But just keep in mind that just because a certificate of insurance was issued evidencing coverage, that the liability assumed under the contract, it still needs to be insured. That means contractual liability. It needs to be on the policy, the contract approved, and/or it meets the policy definition of an insured contract. That's a big subject. I've talked about it before, but just make sure that anytime there's an agreement that those coverages are approved in addition to being on the certificate of insurance. Another common issue with certificates of insurance are errors. In numbers, dates, addresses, named insured information can get confused. A lot of these are basically hand typed or manipulated, so they can have issues. And so it's important for everyone involved in this stream, from the customer, the agent, broker, and the carrier, to review all the details of the certificate of insurance to ensure they're accurate. Again, many contractual agreements will require the insured and ask the insurer to provide them a certain time to notify them in advance of changes in coverage. For instance, 30 days. Most policies will always cancel within 10 days. There will be a 10-day notice of cancellation in the event of non-payment of premium. But keep in mind that most of these certificates of insurance will say we'll endeavor to, or we'll make an effort. It doesn't commit to it, and that's kind of one of the other issues with certificates of insurance. There's cautionary wording. Right? It's evidencing that there's these coverages that exist, but it'll say this is not, guarantee these coverages. It will say, we'll endeavor to make these changes. This is an outline of coverages, and so on and so forth. So most insurers and most insurance agents will cover their tail with this wording, and that's a good decision for them, because these are not the insurance policies. They do not establish a coverage. They do not establish a relationship with the carrier. They're simply a piece of document, basically, that shows evidence to the certificate holder of the coverages on the policy. The policy changes have been made for them to be valid. So certificates of insurance are widely used in the entire insurance industry, but certainly in the aviation insurance market. It's important to understand what they do, what they don't do, and some of the issues you should be aware of. Again, this is just a very high-level overview of some of the common issues. That's why it's very important to have a good aviation legal team, a good aviation risk management team, aviation insurance broker who can help you navigate through these issues to make sure that these requirements that you inherit in an agreement are correctly addressed, and that your certificates of insurance are properly issued and do what they are supposed to do. Well, that's all for this episode. Join us again next time as we continue navigating the waypoints in aviation insurance. Until then, enjoy clear skies and unlimited visibility.
Thanks for listening to the Aviation Insurance Podcast. If you found this episode of value, please share it with someone who would benefit from this information. Don't forget to subscribe in your podcast player so you don't miss any new episodes, and to help our show have more impact. This episode is brought to you by Aeris Insurance Solutions, your flight plan for navigating the turbulence of aviation insurance. For more information, visit aerisinsurance.com. That is www.aerisinsurance.com. Disclaimer: these episodes are for educational purposes only, and due to the changing regulatory and legal nature of the business, some information may change over time. Having a well-educated and experienced aviation insurance broker on your team is an absolute requirement to success in business and for managing your aircraft and aviation business risks.